Thank you for joining us. My name is David Gutowski, and I'm here with Matt Setzer. We're both lawyers with Reed Smith State Tax Group. We've got one of the largest state tax groups in the country, and we've got a dozen lawyers who are licensed to practice in New Jersey. And over the next hour or so, New Jersey is going to be our focus. Specifically, we're going to be looking at potential refund opportunities for taxpayers to take advantage of with respect to the corporation business tax. We're going to start with an explanation of why this year presents a unique opportunity for taxpayers as a result of COVID. Then we're going to look at some opportunities that cover years prior to New Jersey's switch to market sourcing and combined reporting. And then finally, we're going to look at opportunities that cover 2019, 20, and forward when New Jersey implemented a whole host of new reporting rules. So with that, I'm going to turn it over to Matt to talk about how the refund deadlines have been impacted as a result of COVID.
Sure. So generally, the statute of limitations in New Jersey is 4 years. However, as a result of COVID-19, Governor Murphy issued a series of executive orders that extended that statute of limitations. Practically speaking, for CBT purposes, 2015 and 2016, which would have otherwise been closed, are still open under the statute of limitations until April 1st of this year. So you have 6 years open under the statute of limitations now instead of your typical 4 years. So we have some ideas to share with all of you today that you should consider for that additional time period. And also, as Dave mentioned, some new ideas for the combined returns that you recently filed as well. One thing to note, the assessment time period is a little bit different than the refund time period because the statute of limitations for assessment actually is extended until 90 days after the state of emergency in New Jersey. That state of emergency has not ended yet, so the assessment time period is still a little bit open-ended. It's possible that you might see a further extension of the refund statute of limitation as a result of that. Both the statute and the Taxpayer Bill of Rights keep consistent the statute of limitations for assessments and refunds. So that's one thing to keep an eye out for as we move throughout the presentation today.
Okay, so let's start with New Jersey's sales fraction. And since 2014, New Jersey has had a single sales fraction. And let's first start with issues related to tangible personal property. For tangible personal property, the general rule is that you look to where possession of the property transfers. That rule only applies where there is a shipment of the goods. If there's no shipment, then you fall into the default kind of general catch-all provision that asks, where is the receipt earned? So how does this apply to dock sales, where you are selling goods and your customer comes up and picks the goods up from your warehouse and then transports them, in its own trucks or in an agent's trucks? The division's longstanding rule for dock sales is that you source them based on where the warehouse is, where the goods are picked up by the customer. And if your warehouse is outside New Jersey, that's a great rule. But what if your warehouse is in New Jersey? Does that mean you have to report 100% of those receipts in your numerator? Based on the plain language of the statute, we don't think so. And the reason for that is because, again, if there's no shipment, then you have to look to where receipts are earned. And if you look at New Jersey case law involving other types of sales, courts have generally tended to rule that receipts are earned where your market is located. And in the case of a dock sale, your market isn't where your warehouse is. It's where, consumers ultimately purchase your product. Where's the market that you develop for this product? And it's that location that ought to dictate whether you include those receipts in your numerator. So again, if you've got an out-of-state warehouse, great, exclude those receipts from the numerator. But if you have an in-state warehouse, you've got an option here to compute your factor based on where your ultimate market for those goods are, where your customer brings the goods back after they pick them up from your distribution center. Now, what happens if you lose visibility over the goods. You're not sure where your customer brings the products. We dealt with that situation in a number of cases. And fortunately, if you ask your business team, chances are they'll have some reports they can run. They can allow you to estimate where your ultimate market is. If you don't have that, there's still other options. There are third-party databases that you can purchase that track consumer spending down to the product level, and you can use that to estimate, your numerator or your market. If that's not available, and you're selling to big box retailers, it's easy to get lists, reports of where the retail stores are located, and you can match that up with census data, population data. We've done that to get a pretty reasonable estimate of where your products ultimately get sold. So again, you can look to where the ultimate market is if that produces a better result. Another issue to consider, if you are an energy producer or an energy wholesaler, there's pending litigation right now that's asking the question whether electricity is sale of a tangible good or is it a service? And frankly, it's not clear. You could probably ask 10 different physicists, get 10 different answers as to what electricity is. But I think one thing that is clear, it's not your typical tangible good that's moving through the wires. There really isn't a shipment here. So I think the question, the issue, is back to what we talked about before. Where is the receipt earned? And that may not necessarily be the same place as where you produce the energy. It may not be the location of your counterparty. It may be the location where the ultimate consumer uses the electricity. So again, take a look at your fraction if this is the business you're in, and if you're sourcing based on counterparty or where the energy is produced, you may have some options to look to your ultimate market. Two issues for financial services companies. First, if you provide asset management services to mutual funds, you have a potential refund opportunity. If you follow the regulation provides that you look to where the ultimate shareholder is. But that's not what the statute provides. What the statute provides is you look to the location of the mutual fund. And chances are that's not New Jersey. So if you use shareholder location, you have the opportunity to take a position that it ought to be where the location of the fund itself is. That's probably going to reduce your numerator significantly. One other issue, if you have mortgage interest, something to look at. New Jersey is got a somewhat unique geography. It's got lots of vacation homes, second homes. So if you're sourcing your mortgage interest based on the location of the property, that may produce a worse result than sourcing based on where the borrower, domicile is, where they live on a day-to-day basis. So again, you've got some options here. The statute's not clear. The regulations don't address it specifically. Do you source to where the property is located, or do you source to where the borrower is located? I think taxpayers can look at both methods and choose the one that works best for them. Finally, with respect to services, in 2019, New Jersey switched to market sourcing. We'll go through that a little bit later. But for years prior to 2019, the statute provides that you look to where performance occurred or where the cost of performance occurred. But there's a number of cases where New Jersey courts have tended towards a market sourcing even before the statute provided a direct authorization to do so. So kind of the theme of this slide is there's lots of flexibility for each of these types of receipts, and that includes services. If you are performing services outside the state, great. Keep with what the statute says, source them based on performance. If you're got activities within the state, you have the option potentially to look to where your market is, so that you're not overinflating your numerator, having 100% of your receipts in the state, even though your customers are outside the state. And finally, this last bullet here, 25-50-25 rule. Really, what this is, it's a way to mitigate the impact of this all or nothing approach for services. In effect, what it does is it takes the average of a market factor and the cost of performance factor and kind of splits the difference between them. So, if market or cost performance, are extreme, this 25-50-25 rule provides a way to split the difference. So on the next slide, talking about methods that can result in distortion. Let's talk about alternative apportionment. New Jersey, although it's not a UDIPTA state, it essentially has UDIPTA Section 18 codified in Section 8 of the statute. And it allows for the taxpayer to invoke alternative apportionment if the statutory method is distortive. And this is interesting because the standard in New Jersey, generally the courts have said you have to have 100% distortion in order to invoke alternative apportionment. But New Jersey has switched from 3-factor with a double-weighted sales to a single sales factor. So if you are the type of taxpayer didn't have a lot of property and payroll in the state, and those factors are now gone, your taxes effectively doubled. You by definition meet that alternative apportionment standard of 100% just by elimination of your property and payroll fractions.
But Dave, what's wrong with the single factor? Isn't there a Supreme Court case, Mormon, that basically blesses single factor?
Well, I think it's funny how kind of the standard was 3-factor originally, and now we've seen states adopt single factor. Essentially, it's a cash grab against out-of-state taxpayers, and I understand the policy reason for that. I'm not sure that Mormon really stands for the proposition that single factor is per se constitutional. I just don't think that's what the case stands for. But regardless, this is not necessarily a constitutional issue. I mean, you can't have constitutional distortion, but you don't need it here to invoke alternative apportionment in New Jersey. As long as you get that 100% standard, which again is met based on the elimination of your property and payroll fractions, you ought to be able to come up with another way to take into account those out-of-state activities. And
so that's a good point, right? I mean, it's not a constitutional claim. It's really just a statutory claim.
Just a statutory claim. That's right. And, if you look at New Jersey's case law when they had a 3-factor formula, in evaluating the propriety of the sales fraction, whether the sales fraction resulted in a reasonable result, courts are often look to the property and payroll fractions. If the taxpayer had a lot of property and payroll in the state, they tended towards market sourcing to mitigate the impact of having high property and payroll in the state. They reduce that or kind of buffer that with a lower sales fraction using market. And conversely, where a taxpayer has very little property and payroll in the state, they have looked to use this market method, this market approach, to ensure that an out-of-state taxpayer at least has some apportionment in New Jersey if they're deriving receipts from the state. So, that those same principles, I think, continue to apply. If courts look to property and payroll historically to see if your factor was reasonable, I think they ought to still, consider your property and payroll, your out-of-state activities in determining whether your factor under single factor appropriately reflects how your income is earned. So again, if you don't have a lot of activity in New Jersey, you may be entitled to alternative relief. Maybe not constitutionally mandated relief, but under the statute, you can take a position that you should at least get some dilution for that out-of-state activity. Another issue we see with taxpayers is, their domestic operations may generate little or no income, but they may have a slug of royalties coming in from overseas, and that could, account for the majority of their income. And even though it accounts for the majority of their income, it's typically only a small slice of the receipts because they have all this domestic activity, all these domestic receipts that are generating little or no income. On a gross basis, however, those receipts are much more significant in volume than the royalty income. But what happens is you've got this royalty income, it's effectively being apportioned using these domestic sales activities, these regular operational activities, and you're just not getting enough weight on the royalty itself. And the problem is the royalties are very high margin. The other sales are very low margin, and there's a mismatch there. And one way to equalize the treatment is to essentially gross up the royalties, so that the margins are similar, and the representation of those royalties in the denominator accounts for the difference in the margin or in the denominator, and gets you sufficient dilution based on where those royalties are generated. Another option would be using some sort of separate accounting, whereby your royalty income is taxed separately from the rest of your income stream.
All right, with that, we can move into some tax-based issues. The first one we're going to hit is add back. So the general rule in New Jersey is that there's add back of interest and royalties paid to affiliates. So you have your typical situation, say a parent pays a royalty to a subsidiary for the use of intellectual property. The parent has to add back any of those expenses. So let's start with interest add back. One issue we like, if you have payment of tax by an affiliate in any jurisdiction, the NJ filer should be entitled to an interest add back exception. Now, this is different than the royalty add back provisions, and we'll get into that in a bit, but it's definitely an issue you should spot. So if you have a situation where there's interest paid from one taxpayer to a New Jersey non-filer, we think that you should be entitled to an interest add back exception. One other point on interest. There hasn't been a case decided in several years now, and the case law was all over the place on interest add back anyways. So one thing that we want to emphasize is that generally the division had settled issues relating to interest add back. So it's definitely an issue worth preserving, and you can preserve it all the way back to 2015 with the extended statute of limitations. For royalties, there's an unreasonableness exception to add back. One way of showing unreasonableness is payment of tax. So that situation that we talked about, you have a parent and affiliate.
It's not just one way, right? I mean, I guess the division's view is that it's the only way. If you don't show payment of tax by the affiliated payee, you don't get an exception.
Yeah, generally, we'll get into one other flavor of an exception for royalties, but the division has a schedule G2, which the only way that you can show unreasonableness by that schedule is whether the affiliate pays tax in New Jersey.
So it's like a credit for taxes paid. If the affiliate pays $1 million of tax, then the payor of the royalty gets a deduction that's worth $1 million.
Exactly. So your exception to add back is limited by the amount of tax that's paid in New Jersey by the affiliate. So that's the historic rule under the division's regulation. There's this case called Lorillard that comes around. The tax court rules that as long as both the payor and the payee both pay tax in New Jersey, then the payor gets a full exception to add back. Then the appellate division recently reversed that decision and said that the division's subject to tax exception was reasonable. So now the case is back at tax court for constitutional considerations. And we have no doubt that the payment to tax exception is unconstitutional. In-state structures clearly benefit over multi-state taxpayers. However, it's yet to be determined whether Lorillard will win on the constitutional issues and what the remedy will be. But in light of Lorillard, we think it's important that you preserve any claims that you have dating back to 2015. Once again, this is an issue that used to be settled in New Jersey, and you have a pending case that may result in your favor. So it's something to consider and to file a claim to preserve your rights. One other issue with regard to add back, there's this conduit exception. If in the same year you pay royalties to an affiliate and those expenses are then paid to a third party, you should be entitled to a conduit exception under the statute. Moving on to other tax-based issues, the next issue on our slides is NOLs. Historically, New Jersey had a Nol Drd Ordering Rule. We'll get into later whether that has any practical effect as a result of combined reporting. But how it used to work is that you took your NOL deduction before your dividends received deduction. So your NOLs are going to be reduced by the dividends that you include in your base. Now, there were ways to alleviate that. New Jersey had taxpayer-friendly case law on the unitary business principle. So arguably, taxpayers can make an argument that any dividends in their base should be treated as non-unitary and excluded. So one way to alleviate any issues with the Nol Drd Ordering Rule, something to consider back to 2015 if you have dividends in your base that are diminishing NOLs that you utilize in any year.
Yeah, and we have one taxpayer, they're sitting on a pile of NOLs, $1 billion worth of NOLs. They repatriated a dividend from overseas, and poof, those NOLs just evaporated overnight. It was a shock to them. And, the argument here is that, well, that foreign affiliate has nothing to do with New Jersey. And in effect, what you're doing by absorbing those NOLs, reducing the NOLs of the domestic entity, is to indirectly tax the foreign affiliate. And our view is that you can't do that. And if you're going to try to tax a foreign affiliate, then you need some sort of factor representation to account for those overseas activities.
That's a good point. So some other NOL issues to consider prior to combined reporting and separate company reporting years. Prior to 2009, New Jersey's NOL carryover rule was 7 years. So you had 7 years to carry over your NOLs. There was an exception to that. If you conducted research in New Jersey, then you got a 15-year carryover. We think that conditioning the years of your carryover based on where you conducted research, specifically in New Jersey, is unconstitutional. So if you conducted research anywhere prior to 2009, you should be entitled to a 15-year, and now, under the division's proposed regulations, a 20-year carryover for those NOLs. So you could take an NOL that you thought was gone several years ago and carry it over into combined reporting years. So another significant development and something that you should review your NOL profiles for after this call. So why is this relevant now? Why are we talking about NOLs now? We think that it's important in light of a recent case to amend your NOL carryovers as soon as possible. A recent case may tie the statute of limitations to amending your NOL carryover profile. Now, we think that based on particular facts and circumstances of your case, that case may be distinguishable. And it's also only a tax court case, so probably not precedential for all taxpayers, but something to consider and a reason that you may want to amend your NOL carryover in the earliest year that you can. With that, I'll kick it over to Dave.
Okay, a couple more tax-based issues. First, domestic production activities deduction, the so-called DPAD deduction under 199. So for federal purposes, for years prior to 2018, you can get an extra deduction for federal income tax purposes if you conducted certain activities, including manufacturing, food production, software development, and so forth. New Jersey decoupled from the federal DPAD deduction, but only in part. It decoupled from the deduction allowed for software development and for the deduction for qualified production property that was grown or extracted by the taxpayer. It did not decouple from the manufacturing, the deduction allowed for manufacturing activities. Instead, it allows a deduction for manufacturing, but it provides its own definition. It's not keying off the federal definition of manufacturing. Instead, it specifically defines it by statute. And that definition in the New Jersey statute of manufacturing is if you take tangible personal property and you convert it into another form of tangible personal property. So what does that mean? It means that if you follow the regulation, if you follow the return instructions, and you were a software developer or a food producer, you wouldn't have gotten this New Jersey DPAD deduction. And again, we think that's inconsistent with what the plain language of the statute says. If you're a manufacturer, you're entitled to the deduction. It doesn't matter whether the thing you're manufacturing is software or food, as long as you meet the definition of manufacturing, you still ought to claim that deduction. So go back and look. If you're in food manufacturing business, develop software, if you took a federal DPAD deduction, you ought to get one for New Jersey purposes as well. Another issue involves a case called MCI from a few years back. Kind of an interesting quirky case in that the court rules that federal consolidated return regulations apply for New Jersey CBT purposes, even for years prior to when New Jersey adopted combined reporting. The facts in that case, you had, the parent company had cancellation of indebtedness income, and under the federal rules, that got pushed down to some of the affiliates in the consolidated group. The Division of Taxation took the position that the subsidiary had to report that pushed down COD income for New Jersey purposes. And the taxpayers said, no, so New Jersey is a separate company state. The federal consolidated return rules are irrelevant. The court disagreed and ruled in favor of the division. The question is, if the federal consolidated return rules apply in that context, cancellation of indebtedness, where else might they apply? And one thing that comes to mind is sale of stock of the subsidiary. What do you do about your basis? In general, under federal rules, if you've got a subsidiary and to the extent it's earning income, you're going to get an increase in your basis. To the extent it makes a distribution, your basis is going to decrease. So if you sell stock of a subsidiary and it's got undistributed earnings, you have a potential opportunity here. Instead of computing the gain, based on your separate company basis, apply the federal consolidated return rules and boost your basis to the extent that the subsidiary has, undistributed earnings. Now, there's potential exposure there, I guess, if the subsidiary had distributions. In that case, you want to try to distinguish yourself from MCI. But again, if they've got undistributed earnings, take a look at what your basis is, try to reduce the gain on the sale of that stock. Finally, on the slide, foreign corporations. There's a case called Infosys. Essentially, it ruled in favor of the taxpayer and said that the starting point for New Jersey CBT is your line 28 taxable income, and for foreign corporations, it's line 29 federal taxable income on your 1120F. So if your line 28 or line 29 federal taxable income, if your foreign corporation doesn't include foreign source earnings, foreign treaty protected income is excluded from your federal tax base. It also gets excluded from your New Jersey tax base. Now, after this case, New Jersey went, they tweaked the statute to try to effectively reverse the decision in Infosys, but it didn't do an effective job. And as a result, this position remains viable. Again, even after the statutory change, which went into effect in 2019, if you've got a foreign corporation that's in your combined group or is filing separately and it's got foreign source income or treaty protected income that wouldn't be reportable for federal purposes, it's not reportable for New Jersey purposes either.
Let's move on to the last separate company reporting issue that blends into our combined reporting issues as well. So partnerships. What was the lay of the land for partnerships in separate company reporting years for New Jersey purposes? You had this case called BIS, where a limited partner investing in a limited partnership claimed that it didn't have nexus with New Jersey because it had no control over the limited partnership. That was actually a stipulated fact in the case on motions for summary judgment. Tax court agreed, and so did the appellate division with the taxpayer. Taxpayer wins on nexus there. Division then changes its litigation strategy and wins a couple of cases by going to trial and blending the activities of the limited partner, the general partner, and the limited partnership. So the division then wins a couple cases. What's the lay of the land now? Well, recently there was a general partner that was able to settle a case by arguing that it had no control over a limited partnership doing business in New Jersey. Now that's contrary to the division's own regulation. In addition to that, there was a statutory change that came about as a result of combined reporting that states that if you have less than 50% of an interest in an entity, then you have no nexus with New Jersey. So this brings to light JVs. What do you do with JV structures where you own 50% or less? In those situations, we would argue that you don't have nexus with New Jersey. As a result of both that GP case settlement, the general partner case settlement, and the statutory change, we think that if you have any issues in New Jersey, if you have any partnership interest in New Jersey, you should at least file a claim to protect your rights and see if there's any settlement value there. Now,
that's a lot of twists and turns, Matt, and how the cases have come out. If I'm boiling it down, essentially, for years prior to 2019, the rule is doesn't matter what percentage interest you have in a limited partnership or potentially even general partnership. If you don't manage or control it, if it's independent of your own activities, you can take the position that you're non-unitary, right?
I think that's right.
And the consequence of being non-unitary with a partnership is that if you don't have nexus apart from your interest in the partnership, that is, if your only connection to New Jersey is the interest in this limited partnership, then you may escape taxation on your distributive share completely. No tax at either the partner level or the partnership level.
That's right. And that's also a good segue. So what if you do have nexus independent of the activities of the partnership? What do you do then with the partnership interest? So there's a couple possibilities. The division's regulation contains one. You could treat the partnership interest separately, do a separate accounting. Or if you're not resident in New Jersey, if you're a non-resident partner, we think the right answer under the statute and regulations is to allocate that partnership interest to your commercial domicile.
Okay, so essentially, if you've got an interest in a partnership, there's three different ways you can compute your tax, or the tax on your distributive share. One, and let's assume if you can't win on nexus, then the next option is you could do separate accounting, or you can flow up the income and the factors from the partnership and combine it with your other activity and income. Or finally, you may be able to separately allocate your distributive share to your commercial domicile. So in three different ways, run them each way, see which way results in the least amount of tax, and see if your facts support a non-unitary position.
I think that's right. And I think the takeaway here is that much like so many of the other issues that we're discussing today, case law is all over the place. So it's worth it to at least preserve your rights on these issues and see if you can get any value out of them. Yeah,
and I think that's a good point, Matt. I think a lot of these slides, it sounds like we're talking out of both sides of our mouth, and I think that's true. We are, and the reason is because when you look at the case law, you lay it out on the table, and you try to reconcile one case from the other, it can be really difficult to do so. So as a result, that provides uncertainty, but the benefit of that uncertainty, it gives taxpayers flexibility to consider alternative positions.
So moving on to combined reporting. So combined reporting became effective in 2019 in New Jersey. Similar to most states, you combine the income of the members of your group, and then you apportion it to get to a tax due. There are a couple quirks in New Jersey for 2019 and go forward. Let's start with 2019 to 2020. So in 2019, New Jersey required all the nexus members to compute an apportionment factor and a tax due. And then in 2020, New Jersey required only one apportionment factor for the group as a whole. That's pretty meaningless in the math effect from 2019 to 2020, but there's one quirk with respect to PL 86272 that Dave's going to discuss in some of the coming slides. Other than that quirk, what else stands out about New Jersey's combined reporting regime? So with the elections, you have your general rule for a Water's Edge group, and then you have an affiliated group election and a worldwide election. The Water's Edge group is broader than most states' Water's Edge group. With that, you may be able to include foreign affiliates, or the division may try to include some foreign affiliates in your Water's Edge group. In addition, there's no question that the statute for the affiliated group election includes foreign affiliates with effectively connected income to the United States. So how should taxpayers use this? For the Water's Edge group, if you're choosing that default method, taxpayers may want to include low profit members in their Water's Edge group to offset some of the group income. With that, let's move to investment companies.
Well, before we move there, Matt, though, I guess what you're saying is if you've got overseas affiliates, it's pretty easy to trip into New Jersey Nexus, right? They've got a very broad Nexus standard. So if you've got some potential overseas entities that aren't generating a lot of income, but maybe have a lot of receipts that could dilute your apportionment, there are ways to get them into the group. Whereas in the typical combined reporting state, they wouldn't necessarily be in the group, but because New Jersey has such broad Nexus standards, and because it defines Water's Edge to mean something more than Water's Edge, you have a unique opportunity in New Jersey to essentially do a selective worldwide reporting where you don't have to include all the entities in, but you can cherry pick some out, trip into Nexus in New Jersey and perhaps nowhere else, and include them in your group and get that denominator relief.
Yeah, I think that's right. The only word of caution there would be that the division may use that provision as a sword too, and include members in the Water's Edge group that may have higher profits and may actually increase your group income. So
yeah, that's a good point.
You have to look at your profile.
Yeah, that's a good point. I mean, historically, New Jersey has not asserted Nexus over overseas affiliates that don't have physical presence in the state, but they haven't issued any guidance on what they're going to do now with these combined reporting years.
That's right. And then moving on to our first combined reporting issue, investment companies. Investment companies were actually around for a long time. This was a separate company reporting aspect that still exists today. So for investment companies, what does it mean? It means that you need to hold 90% of your assets in other companies. You need to essentially be a pure holding company. This really only benefits New Jersey-based holding companies. The benefit of it is that you get a 60% tax reduction if you're a New Jersey-based holding company. Typically, you would think of a New Jersey-based holding company to compute 100% apportionment factor on its ENI. So they would pay tax on all of their entire net income. But under an investment company treatment, the statute allows you to compute tax on 40% of your entire net income. So the headline and the takeaway here is that New Jersey-based investment companies, they get a 60% tax reduction.
So if you're an out-of-state investment company.
Yeah, so what should a multi-state investment company do?
Yeah, suppose you had a 10% New Jersey apportionment factor. You meet the definition of investment company. 90% of your assets and receipts and income are passive interests. But your apportionment is only 10%. You'd never elect to be an investment company because the 10% is obviously a lot better than the 40% flat statutory apportionment.
That's right. So a multi-state company, they'd rather have the 10% apportionment factor. But should a New Jersey-based company, should a New Jersey investment company be the only one that can benefit from that treatment? We think no. So a multi-state company, we think you should take a 60% reduction of your entire net income and then apply your multi-state apportionment on top of that. And we think that'd be the remedy under the Commerce Clause that a New Jersey court would apply as well. So even multi-state companies should benefit from the investment company treatment. Now, the question is, how do you make the election and what will the division argue? So the election needs to be made either on a timely filed original return or on an amended return. If you do make the election on an amended return, you should be aware that the division may disagree with our constitutional provision and argument. So the division may say that you only are entitled to a 60% reduction of your entire net income rather than getting that 60% reduction and be able to use your multi-state apportionment. Now, we feel that the constitutional argument is strong, and we think you should pursue it. So it's something to look at if you have holding companies in your corporate structure.
So you have to be careful what you wish for, but we think there are ways to, essentially claim the right to make this election without locking yourself into it, such that, if you lose in the constitutional issue, you have to use the 40% apportionment.
That's right.
Okay.
With that, we'll move on to Public Law 86-272 and New Jersey's unique approach to that. Dave, do you want to cover this one?
Yeah, I think probably the biggest shock that we hear from taxpayers that were preparing the first combined reporting return in New Jersey was, what happened to 86-272? And what I mean by that is New Jersey's guidance, what its policy is that if there's any member of the combined group that exceeds solicitation, then no member of that group qualifies for 86-272. So that's, again, a shock. You have federal immunity, but New Jersey's going to ignore that under its combined reporting policy. And we don't think that's what the legislature intended. First off, they had an option to adopt, a Finnegan approach, and they rejected it. And there's no indication that the legislature intended to do away with 86-272. The problem is the division's position does have support in the plain language of the statute. So, setting aside, what the legislative history might be, if you look at the plain language, they do have a position there. And that position gets better beginning in 2020 when the taxpayer is considered to be the combined group as a whole. So if there's one taxpayer and it's the entire combined group, and there are certain members of that group that exceed solicitation, then the division's argument is that the one taxpayer, the group as a whole, has exceeded solicitation, at least with respect to certain member activities. So they do have some statutory support for the position. The problem is this is an end run around the Constitution. And fortunately, in New Jersey, there's some good case law about 86-272, and that the division, can't ignore, that federal immunity under the Constitution. So if you follow the division's return instructions, if you followed, its informal guidance and included income from affiliates that did not exceed solicitation in New Jersey, you have a refund opportunity. You can go back and exclude that income from your base. And so that's 86-272. I'm going to turn it back over to Matt to deal with net operating losses and what's different now that New Jersey has adopted combined reporting.
Thanks, Dave. So we talked about net operating losses from a separate company reporting perspective earlier. What changed as a result of combined reporting? First bullet on here, New Jersey switches from a pre-apportioned NOL to a post-apportioned NOL. What's the effect of that? So prior to 2019, all net operating losses were taken on a pre-apportioned basis. So New Jersey had to develop a method for converting those pre-apportioned NOLs to post-apportioned NOLs. So in a combined reporting world, you're going to have two NOLs. Your NOLs from prior to 2019 that are converted to post-NOLs, and then a group NOL. Now, those NOLs from prior to 2019 that are converted to a post-apportioned NOLs, those are called prior net operating loss conversion carryovers, PNOLs for short. The way that you convert is you actually use your last separate company year's apportionment factor. So you'll use your 2018 apportionment factor to convert your pre-NOL pool, pre-2019 NOL pool to a post-apportioned NOL. Now, that's not always going to make sense. Say you have NOLs coming from 2010 that have a carryover into combined reporting years, and you're using your 2018 apportionment factor to convert those into a post-apportioned NOL. That doesn't make sense on several levels. First, from 2010 to 2018, we moved from 3-factor apportionment to single sales factor apportionment. So you could have had a scenario where you had a higher apportionment factor in 2010 and it moves to a lower factor in 2018. The result of that is you're going to have a lower computation for your PNOL. So if
now, Matt, that may not make sense, but it could conversely be a great result for taxpayers. You could have low apportionment in 2010, and your apportionment in 2018 is much higher. You're going to get more value out of that NOL.
That's right.
As a result of this regime. And I think out-of-state taxpayers, especially service providers, tend to benefit because you can, one, you're going to have, go from three-factor to single-factor. So, out-of-state companies, apportionment's going to tend to be higher in 18 as opposed to prior periods when there was three factors. I guess the other thing to think about here is if normally we're in the position where we're trying to minimize your apportionment formula, your apportionment factor, but if you've got losses in 2018, the converse is true. You're trying to maximize your 2018 apportionment, and as we talked about, there's lots of flexibility with the fraction. So if you got a loss in 2018, I guess the incentive is to look to increase that as much as possible. And as we'll talk about shortly, the nice thing about that is, you can take a position on 18. It's not going to follow you around after 18 because New Jersey has switched to market sourcing. So if you take an aggressive position in 18 on how you source your services, the whole regime, the whole method changes the next year. So you're not necessarily stuck with that high apportionment if you start generating income.
Yeah, that's right. And I think if you run into that first scenario I was talking about, then what you're going to look to is alternative apportionment to increase your factor to compute that PNOL. But as Dave said as well, there's flexible rules after 2018. So it may also be in line to have a higher apportionment for 2018 than what you have in 2019 and go forward. So with that, there's a couple of quirks about New Jersey's PNOLs and then the group NOL as well. Generally, the PNOL can't be shared between other members of a combined group. The only exception there is really if you have a merger between members of a combined group. New Jersey had a historic merger rule that generally would eliminate all losses after a merger, but that does not apply between members of a combined group. Group NOLs, they're freely shareable. So there's not much of a restriction on sharing of group NOLs. Now, we touched on the NOL dividend ordering rule earlier. In practicality, that NOL dividend ordering rule is gone if the dividends are paid between members of a combined group.
Because the dividends get eliminated, right? So
right.
If the dividends are eliminated, you don't have to worry about those dividends the dividends absorbing your loss carryforwards.
That's right. So the only scenario where you're going to have to worry about the dividend ordering rule is the scenario where you have a member from outside of the New Jersey combined group paying dividends to a member in the combined group. In that scenario, the dividend ordering rule would still apply, where the dividends would diminish some of the NOLs that you have.
And then there's, the consequence of that is it's pretty wacky. You could have, a loss company sitting on lots of losses, and as a result of combined reporting, another affiliate, another member receives a dividend. Not even the entity with the losses, but another member in the group receives a dividend from some affiliate outside the group. Under combined reporting, the company with the losses loses their NOL carryovers, even though it didn't receive the dividend directly. At least that's how the division's policy would work. If that's your situation, we don't think that's what the statute provides. So absolutely worth challenging. Again, the profile there is you got one affiliate that has losses, some other affiliate receives a dividend, and it ends up reducing the loss carryforwards of a different entity. Absolutely not what the statute intended.
So with that, I think we can move on to two of our final issues. And one is the New Jersey surtax, and the other is apportionment in 2019 and go forward. So Dave, I'm going to kick it over to you for those issues.
Yeah, so New Jersey, imposed a surtax from 18, and then it's going to continue through 2023. And it's a big deal. It's a 2.5% surtax. And in effect, that's like a 30% tax increase. You go from 9%, the statutory rate, to now an 11.5% rate. Now, there is an exemption to consider. And the exemption applies for public utilities. And what you need to do is lay out your org chart, look at all your different entities, and see if there's any affiliate there that has an interest in or conducts a railroad, a bus, pipeline, gas, electricity distribution, water, oil, sewer, solid waste, or landline or wireless telephone operations. If you've got any that fits that bill, then any affiliate up the chain, any higher tier subsidiary can take the position that the surtax is inapplicable to them. And you may be saying, well, I've got some of those activities, or maybe I own interest in that type of equipment, but I'm not a regulated utility. It doesn't matter. The definition of public utility is very broad. It doesn't depend on you being a regulated public utility in the traditional sense. It really just requires you to conduct one of these types of businesses, or have an interest in an entity that conducts this type of business in order to qualify. So again, you meet one of these activities, take a look, see if you paid any surtax. If you did, you have a refund opportunity. Okay. Last substantive slide deals with market sourcing. As we mentioned before, effective in 2019, New Jersey switched from cost performance to market sourcing for services. And so what does the statute now provide? Instead of cost performance, it now looks at where does your customer receive the benefit. And if the customer receives the benefit in more than one state, then you have to split your receipts up based on the proportion, the relative value of benefit received in New Jersey versus the benefit received everywhere else. Or you can use some sort of reasonable approximation to get to that percentage. So a couple points. First, if your customer has no regular place of business in New Jersey, then no receipts are included in the numerator. Well, let me stress this with an example. Suppose you perform IT services. Your customer's based in Pennsylvania, has no brick or mortar location in New Jersey, but it's got lots of people working from home, especially as a result of the pandemic, and a lot of those folks live in New Jersey. You're providing services, you're going into their computers and fixing things, or providing help desk services. So your customer is receiving a benefit based on where the employees are. But what the statute provides is benefit is determined not based on where the employee is, but based on where the customer's brick and mortar operations are located. And a home office doesn't count as a location of your customer. So if your customer is just receiving a benefit, but that benefit is not received at a brick and mortar office in New Jersey, then none of those receipts need to be included in your numerator. Another thing to consider, the statute provides taxpayers with a choice. If the benefit is received in more than one state, you can either compute the actual benefit received in New Jersey of your customer relative to everywhere else, or use a reasonable approximation. And that word "or" is important. It means that there's no waterfall in the statute that says, you use this method, and if you can't figure out the proportion of benefit received in one state versus another, then you can use a reasonable approximation. It gives you the option from the outset. You can either use the actual value, the actual proportion, or a reasonable approximation. So taxpayers have a choice. And this reasonable approximation is great. The regulation provides a lot of flexibility. Essentially, the regulation is encouraging taxpayers to get creative. It allows a taxpayer to use their own books and records to come up with a reasonable approximation. It also allows them to use third-party data sources as well, including commercial databases or census data to come up with where your market is derived, where your customer may derive the benefit from your services geographically. And what we encourage taxpayers to do here is to essentially get their hands on as much information as they can. Go into your internal database sources, look at third-party data sources, get information from the Census Bureau. We'll also scrape various internet databases, lots of government databases, clinical trial databases for pharmaceutical companies. There's databases from Medicare, lots of different third-party data sets. Combine them all together using a data analytics tool like Alteryx or Power BI, and it gives you a lot of flexibility to come up with different alternatives and kind of compare and contrast them against each other, and come up with a method that really makes the most logical sense, produces the best result for your particular type of business. And this sort of approach, we've been surprised by how different it can be compared to what's recorded in your GL. Based on a particular billing address or customer location. If you go through these sort of mechanics, this sort of analysis, we've seen taxpayers being able to reduce their numerator by 30% or more.
So Dave, using those practical sources like third-party databases, you've been able to use those in some of your cases to have a surprising result, essentially, compared to the GL.
Yeah, that's right. And it's you come up with hypothesis, and then you can test it out with the data. And again, it can surprise you what the data shows, as opposed to what some clerk may input in some GL database. So those are all the issues that we want to address for today. If you've got more questions, we encourage you to reach out to us. And certainly, if you haven't downloaded a copy of our New Jersey Tax Reform Survival Guide, please do so. There's a link here. Our survival guide keeps getting thicker and thicker as time goes on. It's got essentially everything you need to know. It's got a copy of the statute, the regulations. It's got some other materials and all the informal guidance that the Division of Taxation is. Thank you.